to this week's episode of Policy and Profits. I'm Anthony Esposito, founder and CEO of Ascalon 6 Capital. I am not, unfortunately, joined today by EJ Antoni, the lead economist at the Heritage Foundation, my usual partner. He will be back next week. But I'm going to take the opportunity to go through some market-specific concerns that I have. Now, we all know that the market is at all-time highs. Can't talk enough about AI. We cannot talk enough about semis. We cannot talk enough about the broadening trade, everything that everyone wants to talk about. The bulls are up, chests out and running forward, which is fine. I happen to think that we may have some more room to the upside. We've had some downside movement and action throughout June. A little bit of a confusing month, a little bit of a dip down. Overall, first half of the year has been fantastic, and this quarter was definitely a bullish quarter. Obviously, we came to somewhat of a resolution of the war, which is still TBD. But equity markets and risk assets have taken off. I see some potential upside over the coming months, but I do see a lot of risks at this point. Our signals for equity markets had shifted to negative really at the beginning of June, and spent June negative, but kind of getting the back and forth of the price action, which anyone that's following the market or trading it knows exactly what I'm talking about. No big deal. We kind of coming out into a neutral now, and it looks like we're going to get a shift to a positive in the S&P and the Russell in particular, which are the two indices and futures that I trade here as far as equity side. We also have possibly a bottoming out in gold, which is shallower than I thought. I expected 3,500 in gold. Getting a little bit of a move up there, and the correlations to gold and equities have really swung from almost 0 to almost 1 over the past few months. So that's something to watch. But overall, I do see some risks building in the market. And I want to talk a little bit about where they come from. Whether or not there's another 1%, 2%, 10% upside in the market, we have to start talking about the inflation of this bubble, and that comes directly from liquidity and leverage and loans. The market right now, as we have it, is more over-levered than any market I've ever seen. And I say that because we have loans being put into brokerage accounts being margined up, and then leveraged ETFs being bought with that money at sometimes half the price of the asset you're trying to buy. So, for example, the Micron ETF, 2 times Micron, 2 times NVIDIA, you can actually buy that for half the price. So instead of it being 2 times, it's 4 times, and you're levered on the loan. So it's actually maybe 6 times or 8 times. On the way up, it's fuel to the fire. On the way down, it is an anvil, and it is a major problem. I pulled a couple of articles. The first one is from Robert Prechter, talking about the stock market mania and what's fueling it. Margin debt is at $1.4 trillion. That is a record, and we can see on the NYSE margin debt data that we're at 1.4 trillion, and the correlation between peaks in margin debt, euphoria, and peaks in the market are pretty well correlated. And we can see that right through. We're walking through from 1990 through today. That's a scary chart. Anyone that's looking at this and is not concerned with the amount of margin debt out there, the amount of leverage out there, needs to take a step back and just take a breath and look at how much hot air is in this market at this time. I'm not going to go into valuations. I'm not going to go into Schiller PE. I'm not going to go into correlations to prior bubbles. Let's just look at how much money is being borrowed to step into names. If you're borrowing the money to be in the name, you're levered up 1, 2, 3, 4, 5 times. Every time you lose 1% on that account, that's really 5%. Every time you lose 5%, that's really 10%, 15%. This is what will deflate this bubble extremely quickly on a reset. There was another post on X, which I thought was pretty interesting. Again, talking about margin debt at 1.4 trillion. That's up 54% in May. Let's just let that sink in for a second. Margin debt in May is up 54%. This is all being bought on borrowed, levered money. This is not okay. Can it last longer? Sure, it can last longer. But at the end of the day, this is people gambling with borrowed, levered dollars, buying levered products. it's somewhat insane. And in retrospect, we will look back at these articles and we will look back at these comments and say, wow, it was so obvious. Why didn't I see it? Well, it's fear and greed. And right now there's not a lot of fear and there's a lot more greed. We're seeing a little bit of fear and pause stepping into the market as we kind of consolidate up around 7,500 to 7,600. The 50-day held well throughout May and June, so I give it credit. Fear and greed. We are deep in the greed portion of that. When we start to distribute, we will distribute at paces 2, 3, 4, 5 times faster than normal because of the leverage. It's hitting the gas going downhill. It will happen. Just look at this stuff. If we look at the inverse and levered ETFs, I saw a couple of interesting notes here that I'm going to pull. Inverse and levered ETFs have an AUM right now of $200 billion, but leveraged exposure in the market of over $400 billion. Think about that. That's the borrowed money margined up now in levered ETFs. $200 billion levered up to $400 billion. When it breaks, it's going to break hard. If we look at the cumulative notional volume of levered and inverse ETFs, again, think about what this means. This is money that's fake money. They're fake dollars. They don't exist. They're pumping into the market up 50%. That notional volume is up 50% from 2025 to currently in 2026. Think about this. And I think that's a really good way to put it. These are fake dollars. They're not real. They don't exist. They're borrowed dollars and they're levered up. The pace is insane. The volumes are insane. We're just in a spot where we need to be really conscious of how dangerous this is becoming. Bloomberg actually had an article out. They were talking about the growing concern of this leverage that's fueling the market. They're even catching up to it. The highest borrowing cost since December of 2024. We have that article as well. So what's going on here? Well, what's going on is when the prime brokers, whether it's institutional or retail, are charging a finance fee on those margin loans, those borrowing costs are the highest they've been in over 2 years. We're far surpassing previous peaks. Again, this is a major risk to the market, as it is the gas that's lighting underneath the fire and igniting this fire on the way up. It will be a problem on the way down. So what else is there? What else is the risk? Let's not get into, as I said, let's not get into fundamentals. Let's not get into the fact that the Case-Shiller PE, cyclically adjusted PE, is the highest it's been since the dot-com bubble. Let's not get into the fact that we're actually 3 years into this AI bubble inflation and not 2 months into it. So don't believe that story where people are saying, oh, it's so soon and we're in the second inning. We might be in the second inning of the technology. We might be in the second inning of implementation. We are not in the second inning of the AI bubble as far as risk assets go. In fact, this bubble I would challenge is inflating much faster and much more aggressively than past bubbles, including the dot-com bubble. What's another risk to the market? Well, I'm going to pull one out that most people are not talking about and I think are afraid to talk about, and it's the yen carry trade. So we have a chart of the Japanese yen. Japanese yen is actually at its weakest that it has been since 1986. So I saw a funny gif the other day that the last time the yen was this weak, the original Top Gun was in the movie theaters. So for those of you that remember that, you can think back to that. So what's the problem with the yen being so weak? Well, there is something called the yen carry trade. And in short, what happens is you have multiple institutional investors globally shorting the yen, which is a very cheap currency, pressing it lower. They sell the yen, they receive dollars, they take the dollars that have been created very cheaply, and then they put them into risk assets like the stock market. This trade works well, right? You can get it cheap. You can produce a dollar very cheaply, and then you can invest it in the market and make 5%, 10%, 15%, whatever. Lever that dollar up. Again, watch the leverage. Lever that dollar up and create a pretty nice return. The problem occurs when the Bank of Japan takes a look at the yen and says, we need that to be stronger. Our people can't afford imports. Inflation is out of control. So what do? Well, first they raise rates. They did raise rates by 1 percentage point recently. That hasn't helped. I don't know why it hasn't helped, but it hasn't helped. It could be that Bank of Japan was told to stand down. It could be that there are other sellers in the market selling the yen and pressing it. It's very possible. I don't know exactly where they're coming from, but it could be sovereigns. It could be institutional investors, whatever the case may be. I would warn that at some point, the yen needs to be defended, meaning the Bank of Japan will either have to raise rates further and thus strengthen the yen. And by the way, this is an inverse because of the relationship USD yen. So the higher this chart goes, the weaker the yen is. So they'll have to either strengthen the yen and have this yen come back down from the 162 level where it's at, down towards 160, 155 level, or they'll have to intervene directly. They'll intervene directly by buying yen and selling dollars. I don't know that they're going to do that. I don't know what the conversations between Secretary Bessent and the BOJ has been, but I would say that something needs to happen. Now, I'll end on this. The last time there was a yen unwind was in August of 2024, and the unwind occurred pretty aggressively. The S&P 500 was down 8% in 3 days. So I'll say that again. The last time there was a yen unwind, which is effectively the shorts in the yen get squeezed, they have to cover the yen. So how do they cover the yen? Well, they have to sell dollars. So how do they sell dollars? Well, they have to sell the stocks they bought with the dollars, get those dollars back, and then they have to sell those. They have to buy the yen and sell the dollars. So they have to replace everything, okay? And that will create an unwind of risk. August of 24, the S&P 500 was down 8% in 3 days on the yen carry trade unwind. This is a risk that people are not looking at. This is a risk. This is something that you should be watching. So if we look at leverage, we look at the margin costs, we look at the levered and inverse ETFs, and this massive push into, forget zero data expiration options. I don't really want to get into it. And then we look at the yen carry trade and the risk there. I'm just trying to present you with enough reasons and enough information to be mindful of the fact that this is not upwards and onwards forever. This is happening very quickly. And I think that the drawdown from this moment will be very, very aggressive. Now, is it a drawdown that's happening tomorrow or the next day? Well, here at Ascalon 6, we rely on our models to give us momentum trend breaks. I would say that there may be some upside, as I said earlier, from here, but we are seeing signs of a break, particularly on the weekly and the monthly model. So we're seeing a longer term breakdown. Now we're waiting for those trade signals. Be aware that we are closer to the ninth inning than the second inning. So I wouldn't be too concerned with comments from even Mr. Walsh today that we're in the second inning of this AI movement, that we may be in the second inning of the technology. We're not in the second inning of valuations and of risk asset inflation. Be aware of the leverage in the market. Be aware of how dangerous that is. Be aware of the yen carry trade. If that reverses, we start to see a 150 handle, we start to see below 150, you're going to see risk assets unwind very quickly, and it's going to be a very aggressive move. So thanks for listening. That does it for this episode of Policy and Profits. You can catch up on any of my posts at CMT_Anthony on X. You can also visit the website at ascalon6capital.com. Take care. Talk to you guys soon. Thanks again.